Welcome to Charged Alpha. Today we are unpacking Nasdaq Incorporated, ticker NDAQ, and the quiet transformation happening inside one of the most recognizable names in global finance. Most listeners hear Nasdaq and picture the opening bell, the tower in Times Square, the tech-heavy index. That mental model is about 15 years out of date, and Q1 2026 results make that clearer than ever. The headline print was a modest beat. Adjusted earnings per share of 96 cents against a 93-cent estimate, and net revenue of $1.407 billion versus $1.371 billion expected. A 3.2% earnings beat and a 2.6% revenue beat. Respectable, but not the kind of blowout that moves a stock meaningfully. The real story is underneath. That story is Adenza. The $10.5 billion acquisition Nasdaq closed in late 2023 is now driving the entire thesis. And Q1 is another data point that the integration is actually working. So today we will walk through the three segments: the chief executive's long game, the numbers in detail, what the street thinks, bull case, bear case, peers, and where we land on the name. Let us start with the business. Nasdaq is headquartered in New York City, founded in 1971, and employs 9,377 people globally as of the most recent filings. The company now reports in three segments. Financial technology is roughly 38% of revenue, market services is about 31%, and capital access platforms rounds out the remaining 31%. Financial technology is the Adenza-powered segment, that is regulatory reporting software, anti-financial crime tools from the Verafin acquisition, and trade surveillance products sold to banks, broker-dealers, and regulators worldwide. Market services is the legacy exchange business, equity trading, options, Nordic exchanges, the connectivity and data feeds that sit underneath. This is the cyclical piece tied to trading volumes. Capital access platforms houses the listings business, index licensing, investment intelligence, and workflow tools. It is a mix of recurring revenue and transactional income tied to initial public offering activity. The strategic logic is that Nasdaq wants to be a mission-critical software vendor, not just an exchange. Adenza brought in more than 3,000 global bank and broker clients running regulatory and risk platforms. And the Adenza deal was not Nasdaq's first move in this direction. In 2021, they bought Verafin for $2.75 billion. That was the anti-money laundering platform. Adenza was the acceleration, which brings us to the person driving all of this. Adena Friedman has been chief executive since 2017, but her history with the company runs much deeper than that. She joined Nasdaq in 1993, left for Carlyle Group in 2011 as chief financial officer, then returned to Nasdaq in 2014 as president and chief operating officer before taking the top job. She is the architect of both the Verafin and Adenza deals. The consistent thread across her tenure is shifting revenue mix away from transaction-based trading and toward recurring software and data subscriptions. That shift shows up in gross margins. The business has moved from roughly 40% gross margins in the pre-Adenza era to around 55% today. Software mix shift in action, and she has been patient about it. The Adenza deal took heat when it was announced because of the price tag and the debt load. Friedman has spent 2 years quietly proving the math. Let us get into the numbers. Trailing 12-month revenue is $8.27 billion. Trailing 12-month earnings per share is $3.36. Free cash flow is $1.989 billion. Margins are genuinely impressive. Gross margin at 54.8%, operating margin at 29.9%, net margin at 23.1%. Return on equity of 14.6%. Operating cash flow was $2.255 billion on capital expenditures of $266 million. That is an enormous cash conversion ratio, and it is what funds the debt paydown story. The balance sheet is where the Adenza deal still shows up most visibly. Total debt is $9.4 billion. Cash is $564 million. Net debt is $8.88 billion. Net debt to earnings before interest, taxes, depreciation, and amortization is 2.91 times. That is down from 5.22 times at the close of the Adenza deal in 2023. which means Nasdaq has paid down more than $1 billion of Adenza-related debt since close, and they are running ahead of the schedule they originally committed to investors. The other balance sheet item worth noting is goodwill. $14.3 billion of goodwill sits on the books, and the bulk of that is attributable to Adenza specifically. On valuation, the stock trades at $87.04, down 14.5% from its 52-week high of $101.79. Multiples look like this: price to earnings of 26.1 times trailing, enterprise value to earnings before interest, taxes, depreciation, and amortization of 20.6 times, price to sales of 6.0. Price to book sits at 4.1 times. Dividend yield is 1.24% with an annual payout of $1.08, and Nasdaq has raised the dividend 12 consecutive years. Now the most important metric for the thesis. Annualized recurring revenue across the software segments is growing roughly 11% year over year. That is what separates this from traditional exchanges. Financial technology alone now generates more than $2.1 billion of annualized recurring revenue. That is a software company-like number attached to an exchange company multiple. Let us talk about what the street thinks. Consensus rating is buy, 20 buy ratings, 6 holds, 1 sell. Mean price target is $108.50, implying about 25% upside. Barclays is overweight with a $115 target, JP Morgan overweight at $112, Morgan Stanley overweight at $105, Goldman Sachs buy at $108. The lone contrarian is Citigroup with a neutral rating and an $88 target, essentially where the stock trades today. Citi's concern is integration risk and the valuation relative to pure exchanges. What is notable is how stable this consensus has been. The upgrade cycle through 2024 and 2025 was steady, and very few analysts have downgraded on the post-Adenza trajectory. 4 consecutive quarters of earnings beats also supports the analyst tone. Each beat has been modest, between 2 and 5%, but the consistency reduces the risk premium investors demand. The annual earnings trend tells the transformation story cleanly. Fiscal 2022 at $2.58, 2023 at $2.42, 2024 at $2.84. Then fiscal 2025 at $3.57, and fiscal 2026 expected at $3.90. That is a compound growth rate approaching double digits on the earnings line. Let us build out the bull case. Piece 1 is annualized recurring revenue acceleration. 3,000 plus global bank and broker clients from Adenza create cross-sell runway that Nasdaq is only beginning to exploit. Piece 2 is margin expansion. As software revenue grows faster than trading revenue, the gross margin trajectory from 40% toward 55% should continue, with more room to run. Piece 3 is the debt paydown trajectory. Management guided to a 3.0 times leverage target, and they are already below that, which opens the door to buybacks or additional tuck-in acquisitions. Piece 4 is the initial public offering pipeline. After the 2022 and 2023 listings drought, the pipeline is rebuilding, and Nasdaq captures both listings fees and index-related economics. Piece 5 is regulatory tailwinds. Basel IV capital rules, the shift to T+1 settlement, expanded anti-money laundering requirements. All of these expand the addressable market for Nasdaq software. Each regulatory wave essentially forces banks and broker-dealers to buy or upgrade compliance technology. Nasdaq sells the picks and shovels. It is a tailwind measured in years, not quarters. Piece 6, more subtle, is pricing power. Once a bank's risk systems run on a vendor's platform, switching costs are enormous. Adenza's contracts have historically seen mid-single-digit annual price escalators. And Piece 7 is the optionality in data and indexes. Nasdaq licenses the Nasdaq 100 index and related products, which generates high-margin recurring fees tied to exchange-traded fund assets under management. Now the bear case, because this stock is not without real risk. First item is goodwill. $14.3 billion of goodwill, most of it Adenza, creates real impairment risk if growth disappoints. An impairment would be non-cash, but it would be a headline blow to management credibility and could reset the earnings multiple, the market is willing to pay for the software segment. Second is leverage. $9.4 billion of gross debt is significant even after paydown. A recession that hits trading volumes and software renewals simultaneously would stress the balance sheet. Third is trading volume cyclicality. Market services is still 31% of revenue, and that line item moves with equity and options volumes, which are inherently unpredictable quarter to quarter. Fourth is competition in data and indexes. Bloomberg and S&P Global are formidable rivals, and Nasdaq's index franchise, while strong, is not a monopoly the way some investors assume. Fifth is structural pressure on the exchange core. Private market growth, dark pools, and potential Securities and Exchange Commission rulemaking on access fees could all compress market services revenue over time. Sixth is integration execution. Adenza is now in year 3 post-close. Large software integrations often stumble around years 3 through 5 when cultural and platform consolidation decisions come due. Seventh is interest expense. With $9.4 billion in debt, even modest refinancing at higher rates can bite earnings per share. Rate path matters more for Nasdaq than for a debt-free peer. And eighth is valuation support. At 6 times sales, Nasdaq is priced as a hybrid between an exchange and a software company. Miss on either side of that equation and the multiple compresses. Let us look at peers. Intercontinental Exchange trades at 7.8 times price to sales with roughly 11.2% revenue growth. Similar scale, similar exchange plus data model. Chicago Mercantile Exchange Group, ticker CME, trades at 14.2 times sales with 8.5% growth. Much higher multiple, lower growth, but a more entrenched derivatives franchise. CBOE Global Markets sits at 8.1 times sales on 9.3% growth. Morgan Stanley Capital International, ticker MSCI, at 22 times sales on 12.4% growth. And S&P Global at 10.5 times sales on 10.8% revenue growth. That is the benchmark for what a diversified financial data business looks like at maturity. Nasdaq at 6.0 times sales is the cheapest of the group. The discount to CME and MSCI specifically reflects ongoing market uncertainty about Adenza integration and leverage. The bullish read on that gap is that if Nasdaq continues to execute, the discount closes. Even a re-rating to 8 times sales from 6 implies meaningful upside from here. The bearish read is that the discount is appropriate because the business mix is genuinely more cyclical and leveraged than the higher multiple peers. Reasonable people can disagree on that one. On options activity, the near-term change shows modest call-side dominance. Traders are leaning slightly bullish into the next earnings release, but not aggressively so, which is consistent with the consensus buy rating. Implied volatility is near the 52-week low, suggesting the market is not pricing in major surprise risk. That is a tell that positioning is relatively calm heading into the summer print. Insider transaction tone over the trailing 6 months has been neutral. Modest programmatic selling by executives, no large open market buys, no signs of panic exits. About what you would expect at these levels. One governance detail worth underscoring is the 12 consecutive years of dividend increases. Even while carrying $9.4 billion of debt from Adenza, management has sustained that streak, which signals confidence in free cash flow durability. Let us get to the bottom line. Nasdaq in Q1 2026 is a company executing a multi-year transformation from exchange operator to global financial technology vendor. And the numbers say it is working. The verdict for us is constructive, but not euphoric. The Adenza thesis is playing out, the debt paydown is on schedule, and annualized recurring revenue growth of roughly 11% is durable. The main risk is that the market has already priced in a successful integration at 6 times sales. Any stumble on annualized recurring revenue growth or software renewals would invite a real multiple compression. One dimension of the bull case that deserves special emphasis is the upcoming initial public offering pipeline. Several large technology companies have been eyeing 2026 listings, and Nasdaq captures both the listing fees and index rebalancing activity. The index economics are particularly underappreciated. Every time a new company joins the Nasdaq Composite or the Nasdaq 100, Nasdaq earns fees from the financial products that track those benchmarks globally. On the debt paydown timeline, at the current pace, Nasdaq should reach 3 times net to earnings before interest, taxes, depreciation, and amortization by mid-2027. That unlocks more capital for buybacks. The buyback optionality is significant. At 6 times sales, repurchasing shares generates more per-share value creation than it would at 8 times sales. The current valuation actually makes buybacks more accretive. And management has signaled interest in returning to tuck-in acquisitions once Adenza debt is more contained. Both Verafin and Adenza were founder-led software businesses, which is exactly the profile Nasdaq has proven it can integrate. What to watch in Q2 2026? Reporting July 23rd with consensus earnings per share of 95 cents on revenue of $2.15 billion. Specifically, watch the annualized recurring revenue growth rate. If it holds at 11% or accelerates, the bull thesis stays intact. If it dips towards single digits, the Citi bear view gets more credible. Also watch commentary on the initial public offering pipeline, financial technology segment margins, and any update on the net debt to earnings before interest, taxes, depreciation, and amortization trajectory. The macro backdrop matters too. If tariff uncertainty delays corporate capital allocation decisions, that would slow initial public offering activity and dampen new listings. But the software renewal cycle is far less sensitive to that dynamic. That bifurcation is actually part of the bull thesis. Annualized recurring revenue is a contract-based business immune to short-term macro noise, while market services benefits from volatility-driven trading volumes that tend to spike in uncertain environments. The key metric for this stock is annualized recurring revenue, full stop. That recurring base of more than $2.1 billion in financial technology is what separates Nasdaq from every other exchange peer. As long as that number grows and the debt number shrinks, the story works. When those two trends diverge is when you reconsider the position. Until then, the mean analyst target at $108.50 looks achievable. Time for the disclaimer. Everything you have heard on Charged Alpha today is for informational and educational purposes only, and should not be construed as personalized investment advice. We are not your financial advisors, we are not registered investment advisors, and nothing in this episode constitutes a recommendation to buy, sell, or hold any security discussed. The hosts may or may not hold positions in the securities mentioned. Please assume we may have economic interests in any name we discuss, and do your own independent research before acting. All figures cited are drawn from company filings, analyst reports, and public data sources believed to be reliable as of the recording date, but accuracy is not guaranteed, and markets change quickly. Thank you for listening to Charged Alpha. If this deep dive on Nasdaq was useful, please subscribe, share with a fellow investor, and we will see you in the next episode.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.